Hey, how's it going, everybody? Welcome back to the Satoshi Club for another video where today I'm going to teach you everything you need to know about crypto taxes in different countries. So we're going to start up with the United States of America, and then we're going to move on to 10 crypto tax haven countries out there that you can potentially take advantage of. Now, before we get into it, make sure to smash the like button as always, subscribe, you know the drill, and check out crypto news on Telegram when it comes to the Satoshi Club news editions. There's a lot of interesting reads out there. There's a lot of different platforms being released and info about the daily market from the Satoshi Club daily magazine. So if you want to check that out, I do recommend you do so. Now let's get into it with what exactly are crypto taxes and how do they work. So first and foremost, crypto acts as a medium of exchange, store of value, unit of account, and it can be substituted for real money. So these are the basic properties of money, and crypto does tick all the boxes. Now it also means that crypto, or any profits made from crypto, is obviously taxable since it does act as real money. So let's just summarize, right? How do you actually get taxed when using your crypto? First and foremost, if you sell crypto and you profit, you owe capital gains on the profit, just as you would on a share of stock. Now, second of all, if you buy cryptocurrency, if you use crypto to buy goods or services, you actually owe taxes on the value that has actually increased. So between the price you paid for the crypto and its value at the time you spent it. So it's just a difference in value. It's basically sort of like a realized gain tax. Now, if you accept cryptocurrency payment for goods or services, you have to pay business income tax if you are a business, and if you are a crypto miner, the value of all your coins that you actually mine counts as income. Now, when exactly is crypto taxed? Well, first and foremost, if you sell or use your crypto in a transaction, and second of all, if you receive it as payment for business purposes, then you get business taxed, right? How do taxes actually work? Well, they operate on this concept of realized gain. So if you buy one Bitcoin at $6,000 and you sell it at $8,000 3 months later, you'd owe $2,000 gain taxes. So taxes on this $2,000 realized gain that you actually made. Now, these taxes are larger in the short term, but if you hold for over a year, then that means you're basically withdrawing less frequently and you get some tax exemptions, so you pay generally lower rates of tax. Now, in this way, crypto taxes work very similarly to other taxes on assets, property, or even other fields out there. Now, exchanging cryptocurrency for government issued currencies, well, you get taxed, right? Paying for goods or services, you get taxed. Exchanging one crypto for another, you get taxed. Now, this one was quite confusing for me because why would you get taxed for just exchanging one crypto to another, right? Do you get taxed on exchanging, euros to dollars in the exchange office? I don't think you do, unless it's a lot of money going from one country to another. But yeah, this one doesn't really make sense to me. Or also if you receive mined or forked cryptocurrencies. Drop a comment down below if you can explain this to me. I would love to read about it. Now, non-taxable events, well, buying crypto with fiat money, donating, making a gift, or transferring between wallets. Now let's get into a few countries. I know this has been the moment you are waiting for the whole video. So there is 10 countries I'm going to talk about. They are right here in this list on the right hand side, but we're going to start from Germany, right? We'll start by saying the crypto isn't totally tax-free in Germany, but there is some ways to get around it. Germany views Bitcoin and other cryptos as private money, not a capital asset. That means that if you hold your crypto for over a year, when you sell, swap, or spend it, you'll pay no tax on it whatsoever. So basically, holding is the key. But there is some parts of crypto that actually subject to income tax, including getting paid in crypto, mining, staking, or selling, for less than 1 year, or selling staked crypto within 10 years. So that makes sense. Germany is all right. And, let's move on to the next one. So we have Belarus, where they legalized cryptocurrency activities and exempted all individuals and businesses from crypto tax until 2023. So this is sort of an experiment to see what's going to happen. And very soon in 2023, it's up to review. They're going to see what actually happened and perhaps make their whole, economy, this digital economy that they actually built, they may keep it. I certainly think they will keep it because there's no reason exempting individuals from crypto tax could be a bad thing in a digital economy, because if you're Belarus and you're moving towards a digital economy, you want to be able to adapt to new technologies out there, such as the blockchain, right? And if you want to learn more about the blockchain, you can check out my video right here that I did film a few weeks back. Now, El Salvador, we talked about this as well. You can check that out in another video right here, because it is a pretty cool story. They are the first crypto country or crypto city in the world, so it's definitely something that you should keep in mind. These guys did it to attract more investment into the economy, and generally because they believe in cryptocurrency as a digital form of payment of the future, right? Portugal, crypto trading is also tax-free. In the near future, though, they will make some taxes, right? Because this was an update from May of this year, and it seems like they made a U-turn on it. So I guess Portugal is out. Even though it is a sunny beach, a tax-free crypto, it sounds amazing. Well, Portugal might just be out. Singapore is completely a tax haven, right? Because they don't even have capital gains tax in their economy or in their law system at all, right? Money, or spending crypto on goods or services, is viewed as a barter trade, not a payment. Hence, there is no capital gain tax on it. But if you're acting as a business and you accept crypto as a payment, well, you pay income tax. That makes perfect sense. Now, Malaysia, it's also a tax-free country. It is the neighbor of Singapore, and crypto transactions are only exempt from tax when they are not regular or repetitive, which basically means that you shouldn't be withdrawing too often in Malaysia. Malta, the blockchain island, has a huge business income rate tax, but they allow you to make or to get a lower tax rate, but it all depends on how much you earn and your residency. Cayman Islands, always been a tax haven for both money and crypto, so that makes perfect sense. Puerto Rico, if you're a resident of the United States and you move to Puerto Rico, you are going to be paying tax. But if you get your residency before getting your crypto, well, your crypto is totally exempt from the capital gains tax. So lastly, we have Switzerland on the list. They are the crypto valley of Western Europe. It is quite a good country for anything related to monetary value. So in Switzerland, for individual investors who aren't trading on a professional level, which is probably most of us right here, crypto profits are exempt from the capital gains tax. Now that's it for today's video. I hope you guys enjoyed it. Make sure to check the links down below for these sources so you can read up on them yourself and find out some new stuff. Check out Crypto News by Satoshi Club. It is pretty cool. I'll drop it down in the description below. I hope to see you all in the next video. And lastly, I'm not a financial advisor, and you should do your own due diligence before investing into anything in the blockchain or crypto world. So thanks for watching, and I'll see you all in the next one.